Hey everyone, in this video I'm going to answer which one is the better dividend stock to buy for passive income investors. Is it 3M or RTX? In this video I'll compare these two dividend stocks across a myriad financial metrics and answer which one I think is the better dividend stock to buy today. So let's get into this comparison.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Of course, one of the first things dividend stock investors look at when evaluating a stock is the dividend yield. And according to this metric, 3M offers a significantly better dividend yield at 6.49% compared to the 2.54% of RTX. However, it's not just the dividend yield that's important. You want to see how sustainable that dividend yield is. And to do that, we look at the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. Okay, so now that you understand the importance of this metric, you can see each of these two dividend stocks has had a volatile history. Most recently, 3M has had its earnings per share collapse due to legal settlements. It had to pay out billions of dollars. Its earnings per share fell way below the dividend per share. RTX also experienced a moment when dividend per share exceeded earnings per share. And again, most recently, dividend per share exceeded earnings per share. So these two are not pristine in their ability to have higher earnings than dividends, although for the most part of the last decade, they have had better earnings than dividends. So for these brief moments, they can afford to have a dividend payment continue despite briefly dipping below that ratio. I also want you to consider the importance of the cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, Look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. All right, so now that you understand this metric, you can see 3M is nearly double that of RTX at 20.44% most recently, and it's been well above RTX in this metric going back all decade. So it does outperform RTX in this metric. But let's look at the prospects for the next 2 to 3 years. And for 3M, revenue growth is expected to be 1.4% in 2024, and increase to 3.2% in 25, and then increase again to 3.8% in 26. Earnings per share, meanwhile, are expected to grow from 3.5% in 24 to 6.8% in 25 to 6% in 26. For RTX, meanwhile, revenue growth is expected at 5.9% in 24 and then 6% again in 25 and 26. Earnings per share, meanwhile, is expected to increase from 6.1 to 13.1 to 10.8% in 26. So in terms of earnings per share outlook and prospects, RTX has better both revenue and earnings per share prospects over the next 2 to 3 years. Let's look at valuation. So according to the forward price to earnings ratio, RTX is trading at a forward PE of 15, significantly more expensive than the forward PE of 8.973 for 3M. So RTX is way more expensive than 3M. And given the metrics we've looked at, I don't think RTX has earned this much of a premium. I don't think it's earned this much of a premium. Especially when you look at cash flow from operations to sales, 3M is nearly twice as much as RTX. So I don't think I would want to pay that premium. So if I had to pick one of these two dividend stocks today, from a perspective of a passive income investor, I would pick 3M as the better dividend stock to buy today. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.